Welcome back to the Funding Blueprint, where we dive deep into the stories and insights of entrepreneurs who are shaping the future. Today we have an exceptional guest, Adam Siegel, a visionary in the realm of sustainable fashion and retail innovation. Adam is currently spearheading a groundbreaking circular fashion business, bringing sustainability to the forefront of the industry. His journey is backed by a wealth of experience, having previously served as the Senior Vice President of Innovation, Research, and Sustainability at the Retail Industry Leaders Association. At RELA, Adam led initiatives that pushed the boundaries of retail, focusing on the next phase of growth amidst transformative trends like internet, shopping, 3D printing, social media, and big data, while also enhancing the industry's sustainability practices. An engineer with an MBA from MIT Sloan School of Management, Adam has a diverse background consulting for companies in the retail, transportation, and energy sectors. His work with the Environmental Defense Fund and collaboration with private equity firm KKR further highlight his commitment to sustainability and ethical practices. Adam, welcome to the show.
Thank you so much, Avraham. It's very good to meet you and to be with you today. I appreciate the introduction.
Of course, it's our pleasure. So I want to hop right in, and I want us to talk about the lifeblood of any startup, right? Which is cash flow. It's the fuel that keeps your engine running, the oxygen that allows your business to breathe. But there's a common misconception that founders fall prey to. It's confusing cash flow with profit. Now, Adam, many startups get caught in this trap. Can you break down the key difference between cash flow and profit in a way that's easy to understand? And more importantly, why is managing cash flow absolutely crucial for the survival of a startup, even if the business is showing a profit on paper?
Well, Avraham, that's a great question. You sent me the list of questions in advance of this podcast, and I do feel like this is one of the most pivotal questions that I've had to understand leading Recurate. From my point of view, the difference is pretty clear. Profit is the amount of revenue that you're making over how much you're spending in any particular period of time. And cash flow relates to the time period. So just because you're profitable doesn't mean you're necessarily profitable in a particular period of time. It could be that your revenues are delayed and you're expending money before you get money in the door. And of course, that's exceptionally important. As a startup, you have limited capital and you have to make sure that you have enough in the bank at all time to cover your expenses. From our point of view, our primary expenses at Recurate is our team, and they need to be paid every couple of weeks. So if our clients are not paying us on time, and maybe they let one or two invoices go for a month or two, well, that means that we haven't received the cash in time to pay our employees. So for us, we spend a lot of time looking at when money is coming in the door just to make sure that we have enough when we need it.
Great point. And I mean, think of your startup as a high wire act, right? You got a fantastic product, which Recurate does, a passionate team, and maybe even some early sales coming in. But just because you're generating revenue doesn't necessarily mean that you're safe from a nasty financial tumble, right? I mean, the key is managing your cash flow, the actual money flowing in and out of your business. So Adam, many startups get tripped up by focusing solely on profit. How can founders effectively project and manage their cash flow, especially factoring in those sometimes surprising tax complications?
Yeah, well, first of all, if you as a startup are profitable, you're already in a good place. There's plenty of startups out there, including, frankly, ourselves, that we're not profitable, and that's why we go out and seek investment to grow with the ultimate objective of being a profitable business in the long term. How my co-founder and I think about managing the finances of the business is that we start with a foundational financial model. We have a financial model that we update pretty frequently. In fact, we get on the phone together once a month. We review our financial statements from the prior month. We compare it to our projections, and we update our projections based on the reality of the situation. That certainly relates to cash flow as well. If we're finding that our accounts receivable is especially high, we need to go scrape together some invoices to make sure that we're getting the money in the door that's owed to us. And then, of course, each month we also review all of our expenses. Maybe there were some expenses that we hadn't previously predicted, or there's long-term expenses that we need to incorporate into our financial models. We're constantly updating those just to make sure that we have the best information. We're as informed as we can be as we're shepherding this business along.
I mean, you know this better than anybody. Running a startup is a whirlwind, right? I mean, you're the CEO, you're the janitor, and maybe even the social media guru, all roll into one. But when it comes to finances, wearing too many hats can actually lead to some serious headaches, right? As a founder, you're a founder. I'm sure you've had to multitask. But when it comes to finances, wearing too many hats can really lead to some serious headaches. So imagine trying to code, design, and writing your marketing copy simultaneously. It's a recipe for chaos. The same thing goes for accounting, taxes, and financial modeling. Adam, startups are all about scrappiness, right? But at what point does it make sense to seek help with these financial tasks like taxes, modeling, bookkeeping? And what resources are available to founders who want to navigate some things themselves? And how can they really know when it's the right time to bring in these professionals to keep their financial house in order?
Yeah, I do think that the way I tend to think about the growth of a business is that every stage is the next level of maturity. You think about a big business that's been around for 100 years, it's a very mature business. It's got a team devoted to finance, to legal, to operations, to management, to HR. And of course, when you're starting a company, you're the one doing everything. And then over time, you start building a team and you can delegate some of those tasks. And of course, what you're describing with finance is no different than any other component of the business. The way my co-founder and I have tended to think about when it's time to bring in an outside resource, whether it's someone that you need to hire on your team full time to address that particular issue, or to find an outside consultant or contractor, the way we tend to think about it is if we feel like we are spending a disproportionate amount of time on something that we don't think is value add from our perspective. In other words, we bring as founders a unique skill set, but if we can't exhibit that skill set because we are bogged down in some other elements of managing or growing the business, then it's time to offload that work so that we can focus on what we do best. In our particular case, we got an accountant about 2 years into the business. And then a year later, we realized we needed more sophisticated accounting. We have a pretty complicated business, so we needed more sophisticated accounting. And we actually found a great outside firm that focuses on tech startups called Countsy. They have a fractional CFO service, so someone who can really help us understand the finances. And then they also do the basic accounting, just so each month we can look on reflection and see all of that data in one system. They set us up on NetSuite, so we have access to NetSuite. That gives you a whole host of tools, reports, charting, etc., to allow us to manage our finances and review them periodically in that way.
Well, that's great. I mean, do you think 2 years in is a good time? Because every startup is different, right? Obviously, they're doing different types of things. Do you think 2 years is more or less a good time to get in, or maybe earlier?
You know, I only have experience from having done this once, and I would say in our particular case, we did it at the right time. We got an outside accounting firm 2 years in, and that did feel right. But I have to imagine every company is going to be different. It's probably more so dependent on your revenue and your speed of growth. For us at that time, we were growing pretty quickly. We were we were landing a number of contracts, but each of the contracts were relatively unique, and so it took a good bit of time for us to do the accounting each month when we were doing it ourselves. But for other businesses that might be more simple or may not be growing significantly, they might be able to hold on to doing it themselves for longer. I'd say more so it's about the trade-off of your own time. If you're spending a disproportionate amount of time on some of this foundational elements of the business, whereas you would want to spend your time on growing the business, diversifying the portfolio, focusing more on product, then that's the time that you would want to offload the accounting or any other business function for that matter to somebody else.
Right. No, that's a great point. I wanna shift gears for a second, go back talking about fundraising and investments for a second. Man, the world of startup investment is a bit like the weather, right? Things can change quickly. One minute it's sunshine and valuations are soaring. The next it's a downpour and investors are tightening their belts. Adam, with this ever-changing investment climate, how can founders prepare their businesses for potential shifts in investor priorities? And with your experience, what are some key steps that really founders can take to ensure their startup remains attractive and investment ready no matter what the weather brings?
Yeah, well, I think that's such a great point. And, like I said, I have an N of one for launching and growing a business. So I'm kind of learning in real time here. But we started this business in 2020, right around COVID. And, the investment climate basically collapsed for the first few months of COVID, but then roared back. And for the next couple of years, it was the strongest investment climate it's been in a long time. So frankly, we benefited from that. We were able to land our seed round and then our Series A round in successive years, 2021 and 2022. We grew the business pretty significantly in that time, but pretty shortly after we raised our Series A in 2022, the bottom dropped out of the investment market. And we were fortunate that we got the money in the door just before that happened, but we saw the writing on the wall that those valuations and the ability to raise that much capital couldn't last forever and wasn't going to last forever. At that time, people predicted that it would be about 24 months of poor investment climate before things came back. And I think we're right around there now, about 24 months since we last raised and since we saw the bottom drop out of the market. And frankly, I don't see it coming back. I'm not sure when it will. One of the things that I've learned is it goes back to the fundamentals of business. You mentioned at the onset of this call profitability, and I think at the end of the day, it still comes back to that. Like, how can you be a profitable business? So, even if you get a lot of investment, don't spend it too quickly. If you do, rein it back as much as you can, learn from your mistakes. We definitely made some decisions early on that we had to change as a result. Ideally, get to profitability or at least have line of sight to profitability as soon as possible. And I think the other thing that you certainly hear in the tech industry a lot is the concept of product market fit. And I do think that before you spend too much money, really make sure you have strong product market fit. And if you're questioning whether or not you do, you probably don't. There's plenty of literature out there on what product market fit is and what it looks like and feels like for a business. But now having seen both sides of it, I'd say that until you're certain, you almost definitely do not have product market fit.
100%. No, I couldn't have said it better myself. I mean, I want to touch upon the Series A that Recurrate has gotten, and specifically the post-investment success and expenses. You've landed that coveted investment round. Right now, it's time for a celebration for sure, but also a crucial moment for financial responsibility, right? Because you're dealing with a lot of capital. That influx of capital is like a rocket booster for your startup, but if you point it in the wrong direction, you risk a spectacular flameout. So Adam, many founders get caught up in this post-investment excitement and splurge on unnecessary expenses. How can founders actually maintain financial discipline and track spending effectively after a successful funding round?
Well, I obviously follow this space pretty closely and try to learn from some former entrepreneurs that I see to be really the leaders in this industry. And I've gleaned a few things. One of which is that I've seen some founders raise large rounds and then sit on that money. And, a couple of years ago, I don't think I would have fully appreciated why they do that, but I see it now. Sometimes you'll see them raise $20 million Series A, $50 million Series A. These are obviously very large um, Series A deals, but I see the value of that now. And I think what it is that they're still trying to find product market fit. Goes back to product market fit. And until you really are confident that the market is demanding the product that you have and there's a pull, so that you don't have to scrounge for each next client, each next customer, and each next deal, you have to make sure that you are continuing to innovate and spending as little as possible so that once you do find product market fit, you can fuel the fire. What I would caution against more than anything for investors who are doing this for the first time and haven't had that sort of experience is spending too much before you see the growth. Once you see the growth, then you can really fan the flames. But until then, I would suggest holding on to that money and being as frugal as possible. In fact, it reminds me, I had a professor, I studied business, and I had an entrepreneurship professor that invited us to visit several startups in the area. And I thought it's funny. One of the things that he would comment on was the furniture in their offices. And he got really excited when he would see all mismatched furniture, used IKEA furniture. And he'd get disappointed when he would see all new furniture in these office spaces from startups. And I thought, wow, that's such a small thing. Like, it's just irrelevant relative to building a startup. But I do see it now. For him, that was a sign of frugality and the value of being frugal, even if you get a big investment round, to hold on to every dollar until you're confident that you're going to get $2 back from spending it. Until you're at that point, you really need to be cautious about how you spend your money.
100%. It's sacred in a way. I mean, obviously you got it, and you got to make sure that it's spent the right way. And your projections can definitely help you with that. But same here, I see many founders out there that unfortunately don't know what they're doing from a spending aspect. They've raised successfully, but now when it comes to spending, they have just no idea. So couldn't agree more with you on that. What I'll say is we mentioned a lot and we've spoken a lot about, financial aspects of a startup, but there's a whole world of businesses focused on making a positive impact. Today we're going to sift gears and chat with Adam, who works at Recurate, a company on a mission to promote sustainable fashion. Adam, Recurate's concept is really interesting. Can you tell us a bit more about what Recurate does and how it helps brands, consumers, and the environment all at the same time? And additionally, what are the core values that drives Recurate's mission?
Yeah, of course. Well, this is what gets me excited and energized for the future of this business. I come from a background working on corporate sustainability, specifically with retail and consumer brands, and trying to make the industry more sustainable. What we noticed is that there's a growing demand for secondhand products, for used products, and mainly on third-party marketplaces, eBay and others. Um, but the brands that produce and sell those products initially, for which their logo is affixed to the products, they're not benefiting at all from the secondhand market. And so what Recurate does is power a resale experience directly on brands' websites. We work with 40 some brands, Michael Kors, Steve Madden, many others. If you go to their website, you'll see a new tab on their site called pre-loved or secondhand or resale. And if you go there, you can list one of your secondhand Michael Kors handbags for sale, and then somebody else can come along and purchase it off of you. It's a resale marketplace directly on their site. The mission here is to keep items in circulation longer. We kind of have a sub theme where if brands get to benefit not just from the first sale, but the second, third, and fourth sale of every product that they put out in the world, then it makes them want to produce higher quality, longer lasting goods so that they can get a higher resale value at each subsequent sale. So, our mission really is about trying to make the industry more sustainable.
It's amazing, and it seems like you found a solid pain in the marketplace that Recurrent is currently addressing. So I'm definitely going to go ahead and check that out. That's awesome. Well, that's a wrap on the episode of the Funding Blueprint. We hope you enjoyed this conversation with Adam Siegel and empowered you, the startup founder, to navigate the financial waters with confidence. If you want to learn more about Adam and the incredible work he's doing at Recurrent, be sure to check out their website and social media in the show notes. Don't forget to subscribe to our podcast for more inspiring stories and expert advice from the leaders in the startup world. If you enjoyed this episode, please leave us a review and share it with your network. Thank you for listening, and until next time.